There are some surprising new forecasts. Within the next 15 years, the UK economy would be the best performing in Europe, they say. And Germany is losing momentum. So they say the UK will be Europe's best performing major economy over the next 15 years, narrowing the gap with Germany and widening its lead over France, at least according to a new long-term forecast. The Centre for Economics and Business Research expects UK GDP growth to settle between 1.6 and 1.8% by 2038, helping the country retain its position as the world's sixth largest economy. The forecast published last week Tuesday predicts the UK will emerge from years of economic doldrums marked by Brexit and a series of shocks, including the pandemic and rising inflation. The UK economy has been held back by weak productivity growth since the financial crisis, and labour supply problems have also emerged in recent years. And this has led the Bank of England to become more pessimistic about the UK's growth prospects for the coming years. According to the CEBR's long-term world economic rankings, the UK is expected to grow faster than the four major Eurozone economies, that's France, Germany, Italy and Spain, but not as fast as the United States. The fundamentals of the UK economy are still very strong, said Pushpin Singh, that's a senior economist at CEBR. London's status as a hub for financial and advisory services remains strong, and together with the overall strength of the services sector across the UK, will drive UK growth, he says. He said the economic impact of Britain leaving the European Union was either exaggerated or not yet sufficiently researched. The economic consultancy expects China to overtake the US as the world's largest economy in 2037, with global GDP doubling as emerging markets catch up with developed countries. By 2038, Italy will fall out of the top 10 largest economies in the world and be replaced by South Korea. The US and Germany will slide down the rankings, with India and Brazil, two developing countries with large populations, will move up within the top 10. France will underperform the UK, largely because of its large public sector and high taxes, while slowing production in Germany will help the UK catch up, as Singh said. This has to be taken very cautiously. But the sterling had its best year against the dollar since 2017. It's not hard to see why investors flocked back to the British currency after it hit a record low just 16 months ago. The economy performed better than feared, and stubborn inflation meant the Bank of England was starting to ease restrictions, monetary policy they will wait a bit later, but the dollar's attractiveness waned due to expectations of an early interest rate cut in the US. The pound, trading near $1.28, rose nearly 6% against the dollar last year, making it the second best performing currency after the Swiss franc. It's also a long way from its all-time low of $1.03, which it hit in 2022 when then Prime Minister Liz Truss spooked markets with her proposal for unfunded tax cuts. And this means that sterling is on firmer ground heading into a likely election year, but the drivers of the rally are losing momentum. First, the impact of interest rate differentials, which have a major impact on the 7.5 trillion a day global currency market, is fading. Jane Foley, the head of currency strategy at Rabobank, said that while the belief that the Bank of England would lag behind the European Central Bank and the Federal Reserve's policy in easing that had boosted sterling, recent economic data had thrown that theme into disarray. And the UK consumer price inflation fell sharply to 3.9% in November, and UK gross domestic product was revised downward, contracting by 0.1% in the third quarter. Britain may already be in recession and has seen the second weakest recovery from the COVID-19 pandemic in the group of seven after Germany. The data prompted traders to bring forward expectations of a first Bank of England rate cut, with markets now pricing in a 25 basis point cut as early as May, compared to August just at that point. But the uptrend for cable TV has started to get a little more complex, and that is referring to this pound-dollar exchange rate. Without higher inflation or stronger growth, we could see a peak below $1.30. And until the data, the experts were more confident that they would reach the 130 level. The pound has traditionally been considered a risk currency that moves in line with other assets, usually stocks, and the latest gains came as the MSCI World Stock Index headed toward a 2-year high. With valuations somewhat stretched, a turnaround in global equities would pose further risk to the pound. Dominic Bunning, the head of the European currency analysis at HSBC, said the pound's rise from $1.20 in October to $1.27 at the end of November was completely unjustified from an interest rate differential perspective. If you compare it to the stock market, of course it looks a lot more reasonable, he said. And that's the battle that's going on here. At the moment, the stock market is winning, but we are skeptical whether it can stay that way. He expects sterling to fall towards 120 this year due to the weak British economy, which would represent a fall of up to 6% from current levels. Another possible source of instability is the British election, which must take place by January 25, but is expected this year, with polls favoring the opposition Labour Party. The timing of the election could impact sterling by influencing the timing of interest rate cuts, as the Bank of England seeks to avoid influencing national sentiment around the time of the election. And there may also be some caution ahead of the March 6th budget, which local media say could include new tax cuts. And Michelle Metcalf, head of macro strategy at State Street Global Markets, thinks politicians may have learned lessons from the Truss budget debacle. As we head into an election year, this means promises of fiscal largesse will be moderate and funded, he said. However, not everyone expects sterling to weaken. Due to global economic uncertainty, forecasters are far less in agreement than they were a year ago. Goldman Sachs, for example, sees the pound at 135 in 12 months, and that would have been by calmer government bond markets and higher share prices. But as I say, the experts are not even agreeing with each other, so there's a lot of uncertainty still in here. But we will, at the end, know what happens until and after the election with the pound. And if you want to know more, the next video is right here in the end screen. I'll see you there. I'll be back.